All right, good morning, kids. Let's fire it up here. We got an exciting week ahead of us. Nothing like a little bit of non-farm payroll to get us a big, exciting week going. All right, Friday's session, the S&P, we finally saw a correction of over 1%. It's been about forever since we've seen one of these. I think maybe we've only had a 1 or 2% correction either once or twice this entire year until now. I mean, it's volatility had jumped off a cliff. We'd really been just kind of grinding higher, and then all of a sudden you got the payrolls number on Friday. A couple big things there. Obviously, the front number, 294, was a huge beat from 236 expected or something. I think it was 236 expected. The other thing that was a great number there was the unemployment rates, which came in at 5.5%, which hits the technical definition of the Fed of full employment. So I think between the two of those numbers, it really got markets excited. And in terms of from the rate hiking space and the interest rate space, and it led to the correction. So kind of the way that we thought it would play out. If that number broke, we got it. It happened exactly as we thought. Now we just have to figure out what's going to happen going forward. I'm in the camp that very few people are really sitting on the short side of the fence. Very few people are expecting a correction out of the market. The complacency levels feel exceptionally high to me, or have felt exceptionally high to me for the last month or so. And I think it's going to be interesting to see how we play out. We'll talk about it a little bit more in detail as we get into some of the maps and we look at the 10-year Treasury yield and that sort of thing. But a couple of news to back off. I mean, the entire commodity space was soft on Friday after that number came out. I think we could continue to see a little bit more of the same. If you look in the Asian session, we had the Nikkei, which actually corrected after fourth quarter GDP numbers came out a little bit softer than expected. We had Australia, which is obviously down on the back of the mining stocks. Mining stocks getting hit on the back of the higher interest rate yields in the States. Shanghai doing the opposite as it normally does. The rest of the market's a bit of a non-event. So we've got iron ore prices are once again plunging. I think on the forwards and the iron ore price are getting dangerously close to dropping below $50. So that's these are properly low levels. I read another article this morning about how they're still expecting supply to build and into the end of this year, and the surplus is going to get bigger, which obviously is only going to hurt prices even more unless there's some sort of dramatic rise in demand. All right, looking at corporate action this morning with ABI, which came out with full year numbers. Looks like revenue looks like a little bit of a beat. I'm not sure exactly on the headline earnings per share. I can't comment on the half year numbers versus the full year expectations would be out at. So it looks to me, if 253 versus full year at 413, that definitely looks like a beat to me. Divi per share 132 is also a beat. So I think all in all, I think this is probably a nice beat out of ABI. Sasol out this morning as well. Headline earnings per share at 32.9. The guidance they gave us before is a little bit lower than that. That's the consensus number from Bloomberg on the revenue number, so I'm not sure what that matches up with in terms of guidance. Probably, maybe also a bit in line, maybe even a bit of a beat in terms of guidance. But I think the surprise here is on the Divi per share at 7 Rand, definitely higher than what the consensus expectation was. And I think especially after the dividend policy change recently, them coming out and having a better than expected Divi, I think the market might take kindly to that. All right. We had a lot of data out overnight. We had Chinese trade balance numbers, Chinese import numbers, and Chinese export numbers. For whatever reason, I don't see the import number up on here. The export number was a huge beat, but the import number was a huge miss. The import number was a decrease of 20.5% year on year. So, yeah, I mean, you can see there that obviously the demand in China is significantly lower, but the rest of the world doing okay, I think, is what you can kind of gauge out of that. Trade balance also looking a little bit higher. I suppose that's for obvious reasons. All right, if we look at, we had Japanese current account balance which is looking a little bit soft this morning. We had the Japanese GDP, like we said, came in a touch soft, but obviously enough to get the markets coming off even with a weaker yen. And then we had their annualized quarter-on-quarter numbers. So we also have the German trade balance numbers, which are coming out of the opening bell, as well as the German export numbers. All right, let's get into some of the maps here. All right, the first thing I want to look at, and probably what the most important thing for people here locally, is the Rand. Absolutely exploded. I don't know if you guys are paying attention, but we talked about this on Friday. I think we called this pretty freaking well in terms of what was going to happen. Should we get a nice beat? We talked about the Rand going up and at least touching, if not going through 12. Absolutely exploded through to new lows. And I think this is about a 13-year low on the Rand. You can see here breaking out of a bit of an upward sloping channel. To me, the target here is up close to about 1250 on the Rand. Everybody every time continues to tell me the Rand's going to freaking come back and test, but it just never does. So, unless, this is obviously, a lot of this is dollar strength, and I think not just dollar strength, because with the Rand weakened versus other currencies as well, other major market currencies, you're also seeing the emerging market currency basket get totally dumped here, because you're starting to see the interest rate spread between, call it, emerging market interest rates and developed world interest rates, like the U.S. Or not developed world, only the U.S. Interest rates start to narrow a little bit, and that obviously puts pressure on all emerging market currencies. So I think that's the reason why we saw that. I wouldn't be surprised if we do see weaker levels in the yen. I wouldn't be surprised if we come back and test this, the breakout level first before we do start to put weaker levels in here. But bottom line is, you're fighting pretty much one-way action. I mean, we go back here, we look at a 5-year chart in the Rand. It can't look any more freaking consistent than that. Every time this trend line is touched, it implodes upon itself, and it's, I haven't seen anything look that perfect in terms of just gliding along a trend line in a long time. All right, the next thing we're going to look at, and what I think the most important chart of the day really is the U.S. 10-year Treasury yield, which popped out the top of consolidation. We've been talking about this for a while. We've been talking about how we drifted back up here over the last couple weeks, even with a little bit soft data. And then we obviously get the better data point on Friday out of the non-farm payroll numbers, and we explode to the upside. What I want to do here is I'll just look at a 2-year chart on this, and a lot of people are out there saying, well, it's actually not that big of a deal, because we were up at 3% before and we weren't even hiking rates. So down here around 220 225 or whatever is actually not a big deal. But see, what I think they've got that wrong is that I think that 2% is the new 3%, in terms of the fact that we've now, since we were at 3% back here, we've seen all sort of quantitative easing programs come out across. We've seen Australia cutting rates. We've seen New Zealand cutting rates. We've seen Canada cutting rates. We've seen the BOE back off of a little bit of some of the hawkishness. It's kind of come back on, but in the interim it had. We've seen obviously the ECB, which has come out. So you've had German 10-year yields, which have moved from being at like 1.5, 1.25, or sorry, call it all the way up at 2, something like that, all the way down to 35 basis points. And then over that time period, obviously the U.S. was kind of coming down in kilter, because guys would rather buy U.S. paper, so they started to push interest rates lower as they were buying bonds. Well, now what you're seeing here, to me, the discrepancy in the spread that you're seeing here that's opening up, the spread between the U.S. 10-year and the German 10-year is more now than it was when it was at 3%. Now, I think that's what the significant thing is. That's why I think 2% is the new 3%. So I think this is almost like us if we were breaking out through this 3% level here and taking out new lows. Now, because of that, in my mind, I don't think that the market's prepared for this. I don't think that that European central banks, if U.S. data continues to come out good, if the U.S. actually looks at starting to hike interest rates, I don't think that the ECB is actually going to be able to fulfill what they wanted to be able to fulfill with quantitative easing program, because I don't think that any person out there is going to freaking hold on to European paper. You're going to pay, 1% for Portuguese paper when you can pay freaking and get U.S. paper and get over 2%. I just don't see it. I don't know how they're going to be able to keep interest rates that low. I think the quantitative easing program in Europe will actually totally fail on the back of higher U.S. interest rates if U.S. interest rates can hold these levels and continue to push higher. So this to me is a huge thing. I think there could be an all-out collapse in financial markets if this continues to push higher. So I know that that's quite a hectic call, but for me, I think that that no one's paying attention to this. I think it's a huge risk that's out there. I think interest rates do have to go higher in the States for that to happen. If they do continue to go higher, just be careful. I think, I don't think markets are really paying a whole lot of attention to this, and it could really get a little bit messy before people really realize what's going on. All right, let's look at BGA. BGA definitely dropping some sort of support. In fact, I think it's dropping pretty much all support. Down here around 183, you can see that we've dropped there, but there was really some real consolidation right around there. And around 185, somewhere in that neighborhood, you can see that we've really bombed out of. And I think either way you look at it, we've definitely dropped support here in BGA. I wouldn't be surprised to see us get a little bit more of a correction, maybe another 10-15 rand a correction, maybe coming there close to the 200-day. It's definitely shown itself as the least preferred of the local banks. I think especially over this reporting season as well, you've seen how the others have reacted. And so I think that guys may be moving out of this one and shifting into some of the others. All right, we'll look at Aspen. I know I did show this on Friday, but I wanted to just have a look at this again. Just because we did get confirmation on the breakout. We kind of pulled back quite hard into the close, but you can see there after breaking out we had another kind of second day play here after earnings. We traded up to 440 and we really traded there for most of the day. Only dropped down there kind of toward the very end of the session when we started to get under a little bit of pressure. We'll see how this plays out today. I really think this thing can go up and take out new highs again after those earnings. All right, CFR, I wanted to show this simply because, well, for a couple of reasons. We've been in a little minor consolidation here that we've definitely broken out of in CFR, maybe a little bit of a descending triangle here. But I think what's more important than that is if you look at, we'll go to a 2-year here. I'll just shorten it up a little bit. I just wanted to give you the bigger picture view and see where we've kind of topped out a couple times, and we're taking this from the closes. And we've managed to only just, but I think just narrowly breaking out of that little trend resistance there. So I'd really like to see us get above, push above 105 for us to get any sort of confirmation on this, because neither one of these things really looks, significant to me. But if we can start to push north of 105, then I think this thing would be in danger of, trading up to new highs. So, just watch this closely around 105. If we start to make a push above that, I think we could go. And the last one I'm going to show is Sanlam. Sanlam, you can see here, really coming down into recent support levels where we had broken out from. We put in all this consolidation here, failed it, came back up, put in a little bit of consolidation and kind of popped through it. We came down, we had made us close slightly below it, traded down, got back up there. Friday, opened up down there and actually traded lower in the beginning of the session. Huge reversal off of that level and off of support there. I think that's significant. I think if the market holds, I think we could see it push back to highs in Sanlam. That's it for today, guys. Good luck out there.
But the Portuguese bond, giving 1%. Of course they want to buy American bonds.